Alrighty, good afternoon, everyone. We are Hurdle Heroes, and we're excited to speak to you today about Renaissance Realty's portfolio and our vision forward. So here's a quick overview of what we'll be talking about. We'll go over an executive summary, speak to our fund strategy, the macroeconomic overview, take a deep dive at some of our assets, go into our capital strategy, and then risk and assessments in conclusion. So here's an overview of Renaissance Realty's portfolio and where we currently sit. Primarily, the assets are in the southeastern United States with a mix of self-storage, apartments, student and manufactured housing, as well as some built-to-rent communities. Our main goal is to optimize the portfolio and hit those returns of 9 to 11%. Moving on here into our quick executive strategy, kind of talking about the current state as well as the future. So we do have the $50 million redemption to address, as well as several assets that are currently losing value and exposed to certain high risk due to regulatory and macroeconomic factors. A basic explanation of our strategy is to dispose of our assets that are undervalued and then reinvest in build-to-rent, storage, and manufactured housing that are a little more resilient in the market. Going forward, we anticipate increased property valuation, an LTV lowered to 50% on all assets, and a go-forward return rate of 15%. More of a breakdown of our strategy, we're really focused on high growth opportunities in the Sun Belt region. We want to leverage our defensive plays, so speaking more to the student and manufactured housing that are resilient in the market, and then closely monitor headwinds such as potential sectors that are exposed to climate risks as well as heavy regulatory challenges. Our hold and sell strategies are to hold our assets in high growth markets that are very suburban demand driven, which is why we're focusing on build to rent, and sell and exit assets in oversupplied markets that are high cost and that have a lot of operational inefficiencies. For our conviction in the residential sector, it really boils down to four main categories, focusing on population growth, economic drivers, the demographic shift, as well as inflation resilience. So from a population standpoint, we are seeing a lot of migration to the Sun Belt, which is why we're attracted to that market, as well as urban recovery in certain gateway cities. From an economic perspective, there's a lot of income growth, which again supports that move to the Sun Belt markets, and there's a barrier to entry and rising homeowner costs, so we're seeing more people wanting to rent. That kind of leads us to our demographic shift, as I just mentioned. More people are trying to rent. A lot of millennials and Gen Zs actually prefer renting to owning a house, and we see a lot of retirees also trying to downsize and move into smaller markets and smaller houses. From an inflation standpoint, we believe the portfolio is set up to be protected against inflation and against a lot of economic pressures. And here we did consider some residential risks. So the main ones being oversupply in the market, some regulatory challenges, economic sensitivity, and then affordability as well. To mitigate that oversupply, we've been looking at job growth and migration patterns, as I've mentioned, as well as that diversified asset class that really supports us being in the Sun Belt region. We're trying to shift our portfolio towards less regulated and high growth markets to combat some of those regulatory challenges I mentioned. And then from an economic and affordability standpoint, we're looking at stable cash flows, focusing on that suburban demand and really that income growth in Sun Belt regions.
Thank you, Yannick. So just to kind of walk you guys through where we are currently at in the real estate cycle, we have obviously come out of a recessionary period into more of a recovery phase, and we're starting to see a couple telltale signs for this. First off, cap rates are starting to stabilize in this market and are expected to decline. Liquidity is improving, bid to ask prices are narrowing, and we are seeing transactions start to become more commonplace. Lending is expected to grow in this time period, and overall vacancies have actually declined for the first time in over 2 years. With a lot of developments coming online and being delivered, as that supply gets absorbed into the markets, we do expect rents to resume their normal growth trends going forward. And now capital is also starting to flow back in the markets to the tune of about $260 billion, which is mostly targeting multifamily and also distressed assets. And real estate professionals are optimistic about overall price recovery during this time period. We did want to mention a couple overarching trends specifically affecting the real estate industry. For instance, development is faced in a lot of headwinds, specifically with increased interest rates, high inflation costs that affect development costs overall, and also regulatory hurdles that have put a hindrance on construction. We do expect this to be a supply side constraint going forward and into the future, and it will bode well for our pre-existing assets that we currently own. With overall pricing trends and recovery, we have seen that real estate prices or assets have declined quite substantially since their 2022 highs. But over the last 12 months, they have started to stabilize, and multifamily has actually done quite well. So we view this as an opportune time to pick up high quality assets at historically high cap rates. We did have to mention, with the new administration coming in, there will be new changes that are going to be underway, specifically with tariffs, immigration, and deregulation. Tariffs are going to be an inflationary burden on the economy going forward, specifically with the 6% China tariff and also a 10% universal tariff. And then with immigration policy, a lot of the construction workers are foreign born, and a large majority of them are also undocumented. There is very limited overall labor in these markets, so that's going to further exacerbate this problem and make development more difficult going forward. Deregulation should be a positive, however, as there will be ESG rollbacks that we expect, zoning reductions, and also a deregulation for on the financial side. Overall, we see these trends taking place, but we see this as more of a headwind for the industry than a tailwind. Looking at the Fed and overall interest rates, the Fed has always maintained their stance that they're data dependent. We have had quite a bit of strong economic drivers, such as inflation data, job reports, and overall GDP. The Fed has now shifted their focus from being inflationary stance to now viewing both the job market and inflation with the same risk, basically reverting back to their dual mandate policy. Going forward with the inflationary pressures that we did mention, we think this will affect the Fed's rate cutting cycle into the future, and we are seeing this incorporated into property markets, reported by the CME Group, and we do see about a 50 basis points variance between 325 basis points and around 400 basis points, so in that rough area. Some other things that we did want to mention had to do with insurance and regulatory concerns. Overall, along the coastal cities, they have been hit hard by both inclement weather and also natural disasters, and this has caused insurance overall to spike in these regions. We did also see along a lot of the coastal cities that there's been a lot of tenant-friendly policies that have taken place. So we do recognize this is part of our portfolio, and we do want to make adjustments going forward.
So now that Yannick and Tyler have talked us through the macroeconomy as a whole and our thoughts on the residential sector, we're now going to take a look at the Rent-A-Sense Realty portfolio, the fund objectives, and how we can align the two. Starting at the first row of the table, we can see the existing portfolio and the geographic footprint of the portfolio, and it's spread all across the United States, from the Northeast, Southeast, Florida, Texas, and then all the way to the West Coast. In line with fund objectives, we're looking to really consolidate to that southeastern region and focus on Texas, the Southeast. Looking down at the leverage position in the fourth row here, we can see at present we are currently at a 58% loan-to-value ratio, and that's very close to the 60% cap that is in the fund objectives. Moving forward, we're looking to either refinance or add acquisition/development, really keep to a conservative 50% loan-to-value. That is the fund objective. What this allows is at year 5, we expect to have a loan-to-value ratio of 42.5%. Last, moving over to the returns, in a static position with refinancing, we expect to be roughly break even with a levered IRR of 0.74%, well off the fund objective of 9 to 11%. In our base case scenarios, we do see a fund levered IRR of 15.1%. Moving over to the next slide, we can see where the gross asset value is today by asset type. As you can see, it's largely primarily in that value add segment, with a small portion, about 9%, in the development sector. And we do have that 25% allowance for development within the fund objectives. The other thing to call out here is to restate that large loan-to-value ratio that we talked about before. Moving over to what our plan is for the portfolio, we can see our future gross asset value by asset type. First thing to note here is that this is our year 2 valuations, so that really does explain the delta between the $3.2 billion in the static case to this case. Other thing to call out here is the increase in development up to 20%, and we're still staying within the 25% fund cap. And the last thing I'll call out here is the consistent net asset value. As I previously mentioned, and as Cole will go into more detail on, we do plan on keeping a pretty conservative 50% loan to value on all future acquisitions, developments, and refinances.
Thank you, Brett. As we can see here, we have our current portfolio as it sits today. I'd like to point out the Charlotte assets as well as the Gateway City apartments in the Northeast, primarily Boston and New York. We think that the fundamentals right now in the market are pretty strong, but will continue to deteriorate as the hold period goes on. And so we think that these are ripe assets to dispose of, as well as holding our Gateway City apartments in California to stabilization. Right now, they're about 50 to 60% occupied, and we think that transacting those towards the tail end of the first year is kind of the best strategy there, as well as our manufactured housing. We like manufactured housing as a sector, but Florida certainly poses a risk in terms of insurance as well as environmental concerns. And as you can see here down in the right-hand corner, these are our net proceeds from these dispositions. I'll point out that we have roughly $500 million in net proceeds with $50 million attributed to reserves of potential, potential redemptions that may come about over the next few years. Right here, we wanted to lay out the active versus static portfolio returns. I'll draw your attention here to the bottom chart here. This is if we were to just hold the existing assets, refinance them when their debt maturities actually do happen, and coming in at roughly break even. That's certainly not a fund objective that we're looking to commit to. And so here on the top end here is the base case performance. We have a relatively conservative underwrite of just under 8%, but we believe that we can definitely outperform these projections. And here, we wanted to focus on assets that really kind of cater to the graduating up and kind of stepping down in life. And that's your kind of millennial looking to graduate from your apartment and find a space on your own. And for Americans right now, it's very tough to get a down payment, and interest rates are extremely difficult to deal with. And in terms of the cost of living, we think that build to rent as well as manufactured housing is the right play here. And so as you can see here, we have about 2,000 units of development through build to rent in North Carolina and Georgia, as well as manufactured housing, a big value add lift there in Texas and in Georgia, both with very strong return on cost figures. And here, these are the unlevered and levered cash flows of the portfolio going forward. So this does not include the disposition efforts here in year one. We wanted to just show our business plans going forward of the existing assets, as well as our development and acquisition prospects as well. And here we laid out our sensitivity analyses. And as you can see here, we have rent growth being the variable out on the right-hand side on both of these charts, as well as capital expenditures and exit cap rates. And we feel like we have quite a bit of a cushion and comfort in our numbers where we believe that we can really outperform these figures.
Thanks, Cole. So now we want to take a bit of a moment to zoom back and look at more of the strategic focus of why we made some of these sell and hold decisions. So starting off with our Sunbelt apartments and Gateway apartments, a really common theme between these asset classes is we anticipated a lot of market headwinds, specifically some of the stock that's under construction right now, really putting downward pressure on some of that future rent growth, as well as some of the high concessions that are in place in the current contracts. And as Cole had mentioned, we do believe in manufactured housing as an asset class, but Florida poses some problems. So we decided to sell and allocate those funds elsewhere in manufactured housing, but different geographies. And one common theme to keep note of here is that currently a lot of these sell positions that we decided on still have relatively high valuations. So a common theme of our strategy is to utilize these high valuations where we see that returns might diminish in the future, capitalize on that valuation now, and redeploy the capital. Now for some of our hold decisions. We really like the Sunbelt apartments and Sunbelt build to rent, specifically in Texas and Georgia. In a lot of these markets, we've seen a lot of inflow and migration, a lot of income growth in those regions, as well as strong job markets. Just very stable rent versus buy fundamentals right now, which we believe will really carry our rent growth further down the future, and just generally strong underwriting assumptions like an 8% cash on cash yield. We're also going to hold our student housing and self-storage positions. We see these as very stable and defensive asset classes to hold, especially because of some of the market tailwinds that we outlined already, such as enrollment growth throughout the US, as well as prime locations popping up around the country, and students always need housing. We also really like the inflationary resiliency of these asset classes, having student housing specifically, usually one-year leases, really giving us that downside protection should inflation continue to grow in the future. And then with self-storage, just a really low capitally intensive market, and we think that just given where the portfolio was and some of the debt and capital constraints it had originally, leaning a bit further into these self-storage asset class with the low capital intensive nature of it, but also very resilient and sustainable returns was strategic for us. And then lastly, we're also deploying some of that capital we got from the sales to invest in build-to-rent and manufactured housing, primarily in the Sunbelt region, North Carolina, Georgia, Texas. As we've mentioned, we see a lot of market tailwinds carrying rent growth further in these areas. Purchasing costs are currently a lot higher than just renting, and we believe that the demand for affordable housing will just continue to grow, especially as people continue to migrate to low-cost areas from high-cost areas.
So we are aware that this investment, like any other, comes with some risks, and we have positioned ourselves to try and mitigate them, especially talking about inflation, development risks, regulations, and migration patterns. A high inflation environment would cause a higher cost on debt and a higher cost on capital. It will also lower our overall property values. To try and mitigate this, we have done some conservative underwriting assumptions and left $50 million in reserves. A higher cost in labor and material would be a potential development risk for our build-to-rent assets and our manufacturing housings. To mitigate this, we plan on using standardized and simplified designs in order to make a more cost-efficient development and lower the overall complexity. We are aware that migration is a great, from urban to suburban areas, is still a trend on the rise on markets like Atlanta and Dallas, and we have strategically positioned ourselves on those markets to capitalize on that. For ESG landscape has been evolving throughout the years, and more investors are taking into account ESG factors into their decision making. That's why we're committed that all of our buildings achieve a green building certificate. We plan on taking advantage of tax incentives provided by the government, as well as utility rebates, in order to reduce our footprint on the environment and safeguard our shareholders' returns. For our final thoughts, we truly believe that we're in a great position to improve our portfolio, taking into account the market environment and the macroeconomic environment. We believe that by taking some defensive positions, selling off high risk and underperforming assets, we can create a strong asset mix that leverages on tailwinds of the market, and in return get positive returns with lower risks for our clients.
Thank
Thank
you.
you guys.